Konnichiwa and Salam Alaikum. This week we'll be talking about corporate news in the UAE and also Air Arabia's first half result. UAE markets have closed mixed this week, with the ADX at 2,867 and the DFM at 1,924, with stock index movements broadly tracking oil prices and sentiment from overseas markets, particularly emerging markets. In market news this week, telecom company Du has launched its super business plan that has effectively cut its phone and internet sale costs by 50%, another step in it gaining market share from leading company Etisalat, which has a 70% market share at present. Du turned profitable during the first half of 2009 and has an excellent marketing strategy, and we believe that earnings per share will grow strong over the long term and therefore the share price will rise. The UAE government this week announced that it will scrap the 150,000 dirham minimum capital requirement for companies to set up in the UAE. This is a good boost for small and medium-sized businesses and also increases the chances of businesses being attracted to Dubai and Abu Dhabi that operate in the GCC. We believe that the measure will also assist banking earnings that are leveraged to small to medium-sized businesses as this segment of the overall economy grows. In economic news, forecasts for the inflation rate for the full year of 2009 continue to decrease, with the latest market commentary suggesting that inflation will be around 1.5%, down from 8 or 9% in 2008, relieving a lot of the cost pressures facing businesses and helping them to improve their gross profit margins and earnings growth for the coming 12 months. Credit conditions also continue to improve. Conditions continue to improve in the UAE, with the Emirates interbank lending rate for 3 months decreasing to 2.3% from highs of 4.8% late last year. The improving credit conditions continue to make it easier for banks to lend to one another and also increase their asset lending to broader parts of the economy, which we expect will continue to flow through to equity and credit market improvement. In the week, international ratings agency Moody's put the outlook on review for 3 local banks, Dubai Islamic Bank, Emirates NBD and Musrek Bank. Hardly surprising given that these 3 banks remain at the riskier end of banking stocks in the UAE. We expect that non-performing loans, particularly within these 3 banks, will increase over the course of 2009 from an average of 1.5% at present to 3% by the end of the year. We have a preference for banks that are more attractive on a risk and return basis, including First Gulf Bank and National Bank of Abu Dhabi, that both have well diversified earnings bases, low costs, high capitalisation and strong government ties. Our price target on First Gulf Bank is 22 dirhams and 20 fils versus the most recent close around 16 dirhams, implying strong upside over the coming 12-month period. For investors with a slightly higher risk profile, although the outlook of DIB, Dubai Islamic Bank, is under review from Moody's, we believe that the bank offers some share price upside because its core earnings from Islamic income and Islamic investments, or sukuks, remain strong, but during the last quarter the contribution from subsidiaries and associated companies was lower, meaning that net profit was below 2008. However, we think that the low price to earnings valuation and potential for continual strong upside from the Islamic income and investments means that Dubai Islamic Bank is a good bank for investors with a higher risk profile than First Gulf Bank and NBAD. Volumes on the DFM this week have been solid, averaging between 400 and 500 million dirhams per day. We're currently moving into the Ramadan period, which lasts for a month starting from late next week, in which volumes are expected to be subdued versus the yearly average. Therefore, we believe that there may be some drift in the local markets as the volumes dry up, and investors should use this opportunity to accumulate some of our preferred stocks on the DFM and ADX and Nasdaq Dubai exchanges. Our preferred stocks to accumulate at present are Eldar, DFM, Air Arabia, Gulf Navigation, FGB, Do, Agthea, NBAD, Arabtech, Drake & Skull and DP World. For Dana Gas and Aramex, which we have recommended as strong buys in the past, the share price has rallied strongly in recent weeks, and we suggest that investors hold on for further upside, or alternatively sell half of their holdings in each of these companies and let the other half ride upwards, while the first half is reinvested back into our preferred stocks. District cooling company Tabreed reported net profit this week also, with net profit of 19.3 million, slightly below our expectations of 20 million. Revenue actually increased by 3%, however the net profit figure was 22% below what was reported this time last year. We continue to believe that Tabreed has low return on equity, low return on assets, and does not generate sufficient cash flow within its business, and therefore we have an underweight recommendation on Tabreed and believe that investors should consider selling their holdings and switching into some of our other preferred stocks. ABAR Investments, listed on the Abu Dhabi Stock Exchange, has made strong capital gains in recent investments that it's made in Daimler AG in Germany and also in Atlantia, based in Italy. We estimate that the capital gains made on these investments are 5.8 billion dirhams, which equates to 1.87 dirhams per share of ABAR versus its closing share price of around 2 dirhams and 75 fils. ABAR has also made subsequent investments in Falcon Private Banking in Switzerland, Telsa Motors in the US, Virgin Galactic, and also a joint venture with Berndorf Forest based in Germany. Looking forward, the fact that the investment company ABAR has been able to buy all of these assets at distress level prices implies that there is strong upside in the earnings potential of ABAR as the price of these investments increases.